Hi, everyone, and welcome. I'm so excited to have you here tonight as we dive into what I believe is one of the most reliable and consistent opportunities for passive income, the DLP Lending Fund. Before we get started, let me take a moment to introduce myself. My name is Pascal Wagner, and I'm an experienced passive investor who's been investing in alternative assets for over 5 years. One thing that you should know about me is that I don't just talk about investments, but I personally put my money where my mouth is. And I currently have over $1 million invested with DLP Capital across multiple different funds. Why? Because this is an operator I personally love and trust. DLP has a 17 plus year track record of delivering consistent, reliable returns, even in volatile markets like COVID and the rising interest rate environment in 2022. And I've worked with a lot of operators over the years, but the DLP Capital stands out not only for their performance, but their transparency and their commitment to protecting investor capital. Tonight, I'm thrilled to have Richard Delgado, Managing Director at DLP Capital, here with us to share insights into the fund and how it's helped thousands of investors, including myself, create dependable income streams. Here's what you can expect from the webinar. First, Richard is going to pull back the curtain on how the DLP Lending Fund consistently delivers double-digit returns with monthly cash flow, why their approach is so effective, and how this opportunity could fit into your financial strategy for 2025. I encourage you to stay engaged throughout the session. Feel free to jot down any notes and questions that come to mind because we'll have time at the end for Q&A. This is your chance to learn directly from one of the most trusted names in the space. So without further ado, let's dive in. Richard, I'll hand it over to you.
Hey, Pascal, thank you very much. Appreciate you having me on. It's a pleasure to be on with everyone this evening. Again, I'll get through the material here and the content probably within like 20 to 30 minutes. And then we're going to open it up at the end for questions. So feel free to jot down anything, note anything that you'd like to circle back on. But again, we are specifically going to focus on the DLP Lending Fund. We currently have 4 different offerings that are available today. 2 are debt funds. The lending fund is one of those debt funds that's available. And we have 2 equity funds available as well. But tonight we'll be specifically focused on how to generate passive income from our credit fund, which is all about lending to other real estate operators in the real estate industry. So with that said, quick disclaimer from our legal department, just stating again, this is not a solicitation, right? We are fund managers and make our investment funds available, but we definitely encourage you to do your diligence, speak with guys like Pascal, previous investors, existing investors, as well as your tax advisors, your attorneys, your accountants. But again, we're here to answer any questions we can. So with that being said, a little bit about DLP. The company was founded back in 2006 by Don Wenner, who you can see from the picture here is a very young man. In fact, tomorrow is his 40th birthday. So happy birthday to Don. His wife, Carla, his beautiful children, Donnie, Alex, and then baby Jacob. Jacob is adopted, is 3 years old now, but a great family man and has done an incredible job of just creating a tremendous amount of wealth for investors. And you'll see just through this investment fund alone has had more than 160 million in distributions to investors just out of this fund. But we have grown the company now over the last 18 years, over 50% every year, year over year. And we'll talk a little bit about that. Not a fluke, very intentional in how it's grown. Don wrote a book, in fact, called Building an Elite Organization, which is the blueprint for a high profit, high growth business, all about our operating system, the elite execution system that we developed here at DLP and follow on a 90-day rhythm. So we like to say we do more in 90 days than most companies do in a whole year, but that has helped us grow a tremendous business of serving and building thriving communities, but also being able to bring in investors to, again, reap the rewards of those investments and do a lot of good in the community while doing that. And we do that specifically as a direct operator. We do it as a builder, but then we also, in this fund here, lend to other real estate operators. And in fact, that part of our business is becoming a bigger part. As you can see, we've done over $6 billion of loans, and we've purchased and developed over $5 billion of communities. So combined a little over 11 billion, but a lot of things that we have been building up. Today, we have about 1.6 billion of equity underlying all the funds from investors. We serve over 3,000, now 3,300 families, and we have about $5.25 billion of assets under management. So again, in one sentence, right, what we do is we finance the building of thriving communities. And again, that's a very specific formula in what we do. Again, as I mentioned, we do that as a real estate operator. We do it as a builder. We are vertically integrated. So everything we do internally. So that includes all of our development and construction, all of the asset managed portfolio management, all of the acquisition work, capital markets, as well as all the property management enrichment programs that we manage. So as a lender, you can understand that we are very, very different than your typical bank or someone else that is lending as to real estate operators, because of the fact that we are an operator first. So we know exactly what it takes to acquire a property. So when a construction budget comes in, we are the ones that look at that through our construction group. It doesn't just go to an underwriter that looks at it. They look at all of the line items. They can really just go deep into making sure that this is going to be a good acquisition. So the way we look at every loan when we lend is as if we were going to buy that asset, and we have to like the basis. We have to like the project in order to lend against it. We haven't had to step in to many loans. The large majority of all of our loans have performed. And if they have gone a little sideways, we've usually been able to get those borrowers back on track. So for the last 10 years that we've been operating this fund has never had a loss to any investor. We have exceeded our targeted returns in every period you'll see. But again, a lot of that is because we're able to mitigate a lot of the risk because we're vertically integrated. Again, you can see here the last 12 months, we've generated over 500 million in annual revenues. We have over 100,000 residents with over 500 team members in our companies. And probably the one thing I'm most proud of is the fact that we have been on the Inc. 5000 fastest growing companies in the Americas for 12 straight years now. So a really fantastic statistic. And if you know anything about the Inc. 5000, companies that make it there on their 1 year are more likely to go out of business in 5 years than they are to make it a second time on the list. So again, really proud that we're on there 12 years. Where we operate, you're going to see is going to be mainly in the Southeast. But again, East is where we really focus in terms of where we acquire properties. Is going to be generally from North Carolina down to Central Florida, out in the Panhandle to Texas. But as a lender, we will extend a little further out. And we generally like to be close to one of our facilities where we actually have offices. So getting into, again, thriving communities, what do we mean by that, right? Again, it really comes down to these 10 elements. So attainable housing is what we focus on, both from an acquisition side and a lending side, as well as building brand new attainable workforce housing. So we're not talking about government sponsored or Section 8 or LIHTC, right? These are just affordable housing for working families. So think of your teacher, your nurses, firefighters. We want to make sure that they can live in the same communities that they work in. So that's what we focus on. So it's a very different element, right? This is not the luxury market, luxury apartments. This is a vastly needed crisis in the United States. There's over 7 million units short. So you can't build it fast enough. We can't replace it fast enough. So again, there's always that supply and demand tension, right? Which is good for investment purposes, good for us as investors, really bad for society in terms of not having enough attainable workforce housing. And again, I don't have to tell you guys, it doesn't matter where you live. We're here and headquartered out of St. Augustine, Florida, but you can go anywhere in the United States. You can go to Colorado, you can go anywhere, and you're going to know there's a need for attainable workforce housing. But again, as I said, that's a beginning. That's just where we start. These other elements are very important to what we call thriving communities. So that's including having banking and lending and investment, creating jobs, and most importantly, probably deep connections, right? So for us, it's when we build thriving communities, we think of it as a safe community. And we're not talking about making sure you have cameras and lighted parking, right? What we're really talking about there is a community where you could feel like if you had to get up at 2 a.m. and knock on your neighbor's door, you'd be able to say, "Hey, Pascal, I have an emergency. Can you watch the kids?" Right? That's the kind of safety and connection that we're talking about building in the communities we serve. And that really fosters what we've been able to prove really great returns. So you don't have to take concessionary returns to be able to make a deep impact and improve people's lives, give them a great place to live. What it does is it improves the NOI on these projects, right? Because the fact is that ultimately, as people, first and foremost, you make rents affordable, right? They pay their rent. That's just an easy thing that makes it very useful for folks and helps retain people in their communities. And people aren't moving out. They aren't trashing out the apartments, right? You're creating places where people want to live, stay there for a long time. We generally sign 2-year leases on our communities. And then we also provide things like enrichment programs, healthcare, nutrition, right? We also have Bible studies and bring, again, Jesus to all of the folks there. Again, a very important part of what we think is building a thriving community, right? Whether folks want the faith or not, we make it available. All are welcome. We don't ever push it on anyone, but it's something that helps, we think, in building thriving communities. So again, under the DLP Capital brand, you will see we have, from a development standpoint, our Living Fully and DLP communities. So if you didn't know what DLP stands for, it's Dream, Live, Prosper. That was the original name of the company when we first started it. And then we have our Dream Communities, Dream Outdoor Resorts, Dream Prosper, and Dream Living Fully communities. We have all of our sponsored funds. We have our lending business. And then we have our philanthropic side. We have a foundation called DLP Positive Returns, which most folks don't know, but we give 25% of all of our revenue over to the Positive Returns Foundation to do a lot of good around the world. We do a lot in Guatemala, Belize, here locally in the Jacksonville area. We have DLP Gives, which you can do this philanthropic work through donor advised funds. And then we have DLP Bank, which is separate from DLP Capital. Don Wenner, who is the CEO and the largest owner of DLP Capital, is also the largest owner of DLP Bank, but we all invest in all of our funds, and we invest in the bank as well as senior leaders here at DLP. So that's our geographic company distribution. And then when you think about our mission and our goal as a company, right, it's, again, to make a meaningful impact on the affordable housing crisis, right? And we do that in this fund by helping sponsors scale their businesses. And again, excuse me, we have most of our investors are really focused on the DLP Lending Fund because all of these loans in this particular fund are senior secured loans. Again, backed by the development, improvement, and preservation of attainable rental for affordable housing. The debt investments in this fund, right, all first position, senior position loans, they all have personal guarantees. So these are very secure loans. And as you'll see, again, our average loan to value is generally going to be around 55%. The average loan to cost is about 72%. So a lot of equity behind all of these loans, hence why we have such good performance in this fund. So what is private credit, right? When you think about the strategy and the arena we're in, right? And if you think just lending in general, right? Banks were the primary lender to the construction and development space. And again, a lot of banks have backed away, especially over the last few years as interest rates have gone up, right? They've exited the business. That's been great for us as a private lender because we've been able to take over a lot of market share, lend to bigger, better sponsors, and get the high rates that we charge, right? Because we're able to give them a lot of value. So when you think about the capital stack, right, and all of our funds, even our equity funds, we always have common equity behind our investments. So in this particular graphic, right, the senior debt down at the bottom is the first to get any payments if anything ever went wrong. That is the senior debt that we're doing in this DLP Lending Fund. We do have a secondary fund called our preferred our preferred credit fund. That fund does a lot of mezzanine debt and preferred equity. But again, all the loans in the DLP Lending Fund are senior debt. So again, you'll be able to see when you're thinking about the risk return profile, again, you're still getting double-digit returns in the DLP Lending Fund. But again, it is probably, when you think about the risk return profile, the lowest risk of all the funds, right? So naturally, it's going to have the lowest return, but you're still earning double digits. So it means that all the other funds continue to step up as that risk goes higher. You start earning higher returns, even greater than the lending fund. But that being said, you can see the DLP Lending Fund targets 9 to 10%. Our other funds are 10 to 11, 10 to 12, and 11 to 13%. We have never missed a targeted return in any of our funds ever. We've never missed a preferred return. So for instance, in the DLP Lending Fund, we'll get into this a little bit further, but we pay an 8% preferred return that gets paid to investors before we earn our management fee. And all of our funds work the same way, where we put our investors first with a preferred return. Specifically in the lending arena that we're in, right, when we look at the type of approach that we have in terms of really the lending business, right? We focus on single family. That's a smaller portion. Most of it is going to be multifamily. But again, we do a lot in the manufactured housing space, in the mobile homes, parks. And it's, again, existing properties, new construction, but mostly all going to be communities. We do very little on the scattered home sites. And we look, most important thing for us is experienced borrowers who have a strong track record of being able to enter into projects, complete the projects, and exit those projects successfully. So you're going to see when we get into our statistics on the DLP Lending Fund, the average borrower in our fund has over 150 projects that they've completed. So a lot of experience. We also focus on those particular regions, as we mentioned, where there's going to be high population, high job growth, again, high wage growth. And that's very important for us as we think about the markets. So if I had to ask you, and you guys can tell me at the end if you agree with this, but if I asked you what two states make up 60% of all the growth in the United States, I would suspect most of you would be able to get it right. And that's Florida and Texas. So again, you can imagine most of what we do are going to be in those two states. So again, making sure that we keep things very, very, very disciplined. I'm going to give you a few examples of the type of loans that we've made. This particular loan was a little bit over $5 million, close to $6 million. And this was for 34 townhome lots. Again, the borrower on this particular project took out a 12-month loan, paid it back within 10 months. It had a 68% loan to value at just shy of 13% interest rate. Again, great 1.5 acres, 3 parcels of lands, not far from us. So again, able to lend and then get this money returned very quickly. Similarly, we had another lot development project out in Justin, Texas. This was another great loan that we did, a little over $11 million. This particular loan was extended for 12 months, 537 acres, a 31% loan to value. I mean, think about that, at a 15% interest rate. And this particular borrower sold this property here to D.R. Horton just 3 months later for $31 million. So a great loan for us, great project, not just for us, but for the developer as well. So a beautiful, again, piece of property with nearly 2,000 lots developed. And then again, the last example here is another one. This is in Pinehurst. Again, if you're a golfer, you'll know kind of the area in Southern Pines, North Carolina. A $64 million loan to a great group. This is a generational developer, the Zimmer Development Company. Again, another great project, 269 units. This particular loan is a recent loan. We just closed this a few months ago. And again, it's extended a 24-month period. So again, 66% loan to value, 80% loan to cost. You can see here from the stats, $97 million as stabilized value with a 12.5% interest rate. So a great loan for us. They purchased that land and developed it, and we closed that construction loan here in August. They expect to have the construction completed in 2 years and then be stabilized by the end of 2026. So for us, a great short-term loan. You can see from the concept here, the kind of clubhouse, beautiful type of projects. These are great developers with great experience, great vision, a lot of great fundamentals. So again, thinking about just when you think about private credit and you're thinking about why would you do this, right? The biggest is that you're going to be at the senior part of the capital stack, right? You're going to take a nice position with a very liquid fund. Again, these are all short-term loans, 6 to 36 month in terms. The average duration of our loan is just a little over a year. So we get a lot of velocity of return of cash flow. So again, when you're thinking about liquidity, these particular funds are great because there's a lot of cash flow that comes through. We offer that liquidity, and you're going to see we have 90-day liquidity in this fund. So you can exit at any time with 90 days notice. So again, very great risk profile with a great return on this. Downside of it, right? When you think about overall compared to like our equity funds, right? Our DLP housing fund, since its inception, has done about 19.5%. So you're going to take a lower return. That's the downside, but you're going to have a lot more protection, a lot more liquidity, and a lot more current cash flow coming through because we distribute all of the cash in this fund every month as a private REIT. And how do you know if this is a good fund for you, right? Again, if you're prioritizing the risk profile, right? That's the first thing. And I have a lot of investors, I just talked to an investor earlier today, said, I'm retired, in my 60s. I really am not looking to take a lot of risk. I just want some good cash flow. Perfect fund for someone like that, right? That's looking to just have cash flow. This is also, and you believe it or not, a great fund for real estate operators. We have a ton of operators that actually park their money in this fund because, again, as markets are slow or there's a hard time to find new deals, they just put their money in this fund. They can earn a 10% plus return and have 90-day liquidity, meaning whenever they need to access a deal pops up, they can come and grab their cash flow. And if you have any questions on that, I can put you in touch with a bunch of operators that can attest to, their investments and their ability to get access to the cash when they need it, and have that liquidity, which is a great way, again, to manage your funds and have a low risk profile. So looking at this particular fund, we'll get into, how it's performed over time, but looking at the most recent fund that or month that we are reporting, we'll be getting the November reporting out here shortly. Typically by the 20th of the month, we already have information for the prior month. All distributions, this particular fund has 2 distributions every month. It pays the preferred return of 8% on the first of the month. And then it pays everything above that 8% preferred by the 20th of the month when we do the reporting. You can see here, this has done extremely well since its inception. Again, low LTV, low average LTC. It has $1 billion out the door now in terms of the fund AUM, has total loans of $1.4 billion. So again, there's about $400 million draws that are going to be paid out over time as construction loans continue to draw on themselves. We have $534 billion of equity within the fund, which means we have another $500 million of debt behind us, and I manage the debt funds. Again, my experience is 30 years in structured finance, managing credit facilities. I had $7 billion of warehouse lines across 14 different lenders at the place that I worked at right before coming to DLP. Again, great opportunity with very low risk. This particular fund has your typical 2 and 20 model, so 2% management fee that doesn't get paid until you get your 8% preferred return. Everything above that gets split 80-20. So a 20% performance fee to us and then 80% to investors. And then everything that I talked to you about, all these returns, right, are going to be net to you as an investor. We started this fund, again, over 10 years ago, have had a great track record, all with, great liquidity. So a great fund. These are some of the statistics you can see, as we mentioned earlier, 73% of these loans are in community loans, 22% are in land and commercial loans, very small percentage of commercial, 2%, and then small percentage of scattered lots, again, in terms of multifamily and single family. Top states you can see, again, Florida and Texas, right, in terms of the top 5, followed by Carolina, Colorado, Pennsylvania. Again, borrower type, we talked a little bit about their experience. So average completed projects, 152, average number of loans with DLP at least 3, high credit score, high average liquidity, high net worth, great performance on these. And you can see from a performance standpoint, right? I mean, less than 3% delinquencies, which is, somewhat abnormal in this space because the average delinquencies for other lenders typically runs in the 10% plus range. Again, for DLP, that usually runs anywhere around, 2 to 4% is on average what our delinquency runs. This is just going back to 2019 to show you, again, the monthly returns. Again, and if you annualize those returns, you can see that we've never had a month in the 10-year history that's ever been less than 10%. So again, a really great track record in terms of performance. These are all the new loans. So when you get your reporting every month, we give you the lending fund report, which is what you're looking at here. We give you the lending fund financial statement. So you get a balance sheet, you get an income statement, you can see all of the information behind it. We give you a loan tape. So you see every loan that's in the fund. So not only do we put it in the report, any new loans that we originated, any loans that have paid off, which is, a big part of this business, right? As you're doing lending, right? You don't want to just be putting money out. You want to see that velocity of money coming back, loans paying off, borrowers exiting their loans, right? That's going to make a big difference in how you run your business. So you can see we just did 3 loans, or the 3 largest loans in October were all in Colorado. Again, great opportunities, 2 multifamily communities, 1 land, and then again, a bunch of other land and commercial loans. And then we had a bunch of payoffs, right? So $22 million loan payoff, a $16 million loan payoff. And again, you can see just great to see the velocity of loan payoffs in terms of originations. So to this fund, we went through it. We've got 534 equity. We have $1 billion in out the door, 1.4 in total loans, 0 periods of missed preferred returns or 0 periods of missed targeted returns. Again, we've exceeded our targeted returns in every period for this fund. In fact, we've done that for every fund, and we've never had any loss to any investor in this or any of our other funds. Again, most important thing, right? You can see going back to the very inception of this fund, the growth in the cash distributions to our investors. So again, last year we distributed over $40 million to investors. And we've done that already this year through October. So continuing to grow this fund, close to 170 million of distributions to investors since the life of this fund. And again, exceeding our targeted return for every period. And again, this is interesting here, and this is, I'll preempt it because again, I hope to get some questions about the returns, right? As you think about bigger, better sponsors, you have to think that we're going to lend at slightly lower rates. But the reality is that this is really a product of what we'll call margin compression. So we lend at fixed rates. And as our cost of funds have gone up over the past few years, right, with rising interest rates, the margin, the spread on what we lend out at and what our cost is has narrowed, right? So we're still able to get you a 10% plus return, even with those high interest rates. So now when you think about rates coming down, right, that's going to increase the margin and these returns are going to increase, right? So again, there's a lot of great expectation for these funds going forward. Again, why you should consider this fund if you're, again, looking for a lot of security, you want really have senior secured loans, if you're looking for liquidity, if you want high income, right, in terms of monthly distributions, and you want no lockout period, right? You want to be able to access your money at any point in time. So that's all I have on the fund. So a couple of things to mention to you. And, you know, Pascal mentioned we met at a dinner in Denver. He also joined us for a dinner we did last year, actually not this year, earlier in the year in Boulder. We do get around. I was just in Palm Beach this week. We did a dinner down in Cafe Balud in Palm Beach. So we get to some really nice places. These are just some of the dates that we'll be going out for what we call our micro dinners and capital dinners. We'll also be hosting dinners at a lot of the upcoming events at Kingdom Advisors in Orlando, at the White Coat event in San Antonio, as well as the Physician on Fire event in March. So we get around. And probably most importantly, if you haven't been to one of our own sponsored events, the one in June from June 25th to June 28th, our next one is going to be in Asheville, North Carolina. It is our Extraordinary Impact and Family event. These are great events. Pigeon Forge, Tennessee this year. And again, great. You bring your kids, we have content for all ages. And then this November, we just did a great legacy and impact event. We had great speakers. We had John Maxwell. Oh, sorry about that, folks. Lost you there for a second. So we had John Maxwell and a bunch of others there. Let me get this back opened up here. Let's see. There we go. I think I'm back with you. So we had a great event in November with John Maxwell, John Gordon, Mark Batterson, just Tim Tebow. I mean, a great lineup of speakers. It was a great event. So we welcome you. You could take a screen of that little QR code or get in touch with Pascal. Again, before February 15th, the only cost to that event will be a $250 donation to the DLP Positive Returns Foundation. After the 15th of February, there will be a cost to attend. So again, if you're interested in that, get in touch with me or Pascal early and we'll help you that. Again, this is going to be in the beautiful Omni Grove Hotel in Asheville, North Carolina. That said, these are my colleagues here at DLP. This is my team. So you can see there's a great number of guys and gals that you can touch base with, answer any questions you have. You can get in touch with me directly. Pascal and I have to work together on his investments. So again, I'm always happy to talk to anyone. So with that said, I'm going to turn it back to you, Pascal, and we'll answer any questions.
Yeah, no, thank you again, Richard, for walking through this presentation. And for those that are here, would love to just open up the floor. As Richard said, a great time to ask some Q&A questions to Richard directly, if you have any. All right, let's see. We got one. I just need to figure out how to, there we go. And you just need to unmute yourself and camera on. Mark. If it lets us. All right, and Brad, you should be able to ask as well. There we go. All right, Brad, I'll let you go first. Take it away.
Brad, we're not hearing you. I don't know if you've got, there we go.
There we go. Sorry, I'm muted.
Excellent, dude.
All right, there we go. Yeah, no, appreciate it. That was all great information. Sounds like guys are doing awesome there. So let me ask a question, just like from a market viewpoint, if you guys are kind of focusing on strong track records, these operators that have done a lot of deals, that have, very good experience in this, why would they want or get a 13 to 15% rate from you guys versus like somewhere else when, if they do have that track record, you would think maybe they could get a lower rate? Or, I mean, can you kind of explain the market dynamics there on why that process works?
Yeah, sure. So we'll talk about first the lack of lending in the space, right? So banks are out. So where they used to be able to go to the banks and get the same loan that we're giving them, and I shouldn't say same, similar loan, I'll say, because I'll tell you a little bit about some of the extra protections we give our investors through the lending we do. But let's say a similar loan, typically at maybe 5% less, right? I mean, so talking about, 7-8% probably in terms of what their note rate might be. But they're probably in today's market, right? Other lenders, if you look at it, if they can get a loan at, let's just say 8-9%, right? Which is going to be lower than what we're going to charge. They're going to probably cap out at, anywhere 55-65% in terms of max loan out, right? So the problem with that is that's not enough. They got to come out with a ton more of equity. So if they have to go out and then say, okay, well, now I'm going to put on some mezzanine debt or subordinate debt on top of that, right? That's going to be at significantly pref equity rates. You're probably going to get into your high teens, low 20 type of rate on a weighted average basis. They're going to probably wind up similar or above the rate we'll charge. So we can get them there with the full loan with a higher amount of cash out the door. But what we get is we get extra protections, right, with the personal guarantees. And part of the reason that most developers have come and worked with us is because of the value we add. So in addition to just accessing and giving them capital, right, we give them a lot of education. So one of the things that we talked about a little bit in my presentation was the Elite Execution System, which is our operating system. It's how we scale and grow our company over 50% every year. A lot of them want to be able to do that, right? So we can go in, help them implement that same operating system. We give them the software, we give them the tools to be able to do it. We coach them, but then we have a lot of experience, right? We've been doing this for 20 years now. We can help them also with their projects. So when we're looking at a construction budget, right, we can say, well, that's not what we're seeing in this market, right? Prices are different, labor is different, cost of materials are different. And so we can help them calibrate to make sure that when they go into this project, they're going to make money, right? As opposed to saying, hey, they're going to go in. I can tell you how many times we've had borrowers get really upset at us because we won't make a loan for them. But then they come back, a couple of months later and say, thank you for not making that loan. I would have blown my brains out. Let's try this one instead and help me figure it out and get to the right place. So it's a lot of more of the qualitative nature of why they're able and want to work with us.
Great. Yeah. So the expertise is a big thing also.
Yeah, absolutely.
Can you the other thing I just had was, if you can maybe send a list of operators that have invested or kind of parked their cash, as you mentioned specifically, that'd be great. Especially maybe in Texas. I talked to a few in Texas. So
the ones
my only other comment is
Texas.
Yeah. You don't have any events in California and San Diego, so
So
but
we did one last year so we went to the NMHC conference and we did a capital dinner out there. So while we don't have it on the calendar yet, I would imagine, there's probably a dozen other cities that I didn't show on that list that we'll set. So we do Scottsdale, we'll get out to San Diego, we'll do San Francisco. We get out to LA at least once a year. So we'll get to California, multiple locations, but then we hit a lot of other areas between here and there. Yeah.
Yeah, you don't have to invest in it, just to come visit it.
Exactly. Yeah. And our events are open to everyone. Pascal will tell you, we have existing investors, prospective investors, existing operators, prospective operators, right? People that might want to borrow from us come to our events. We get existing, team members, management, we get prospective team members. We even invite, folks that we might think of hiring, come and see what we do and how we do it, meet the people, talk to them. And the only reason we can do that, right, is to be open and transparent, is the fact that, we do have a good track record. We have nothing to hide. And so it makes it easy to bring everybody together. And that's the best way, right? Pascal can talk to 20 different investors and find out, yeah, these guys are happy. They distribute on time. These guys pay on time. They report on time, right? So it's a little bit of extra diligence you can get by joining one of the events.
Awesome. Great. Let me just other people might be thinking it too. I mean, there's 200K as the minimum investment, I think, right on the website. I know Pascal has some 50K maybe minimum too. Can you guys talk about that? Is that something you can address?
Yeah, certainly. For us, I mean, it's we and believe it or not, we were at 500,000 at one time. That minimum came down a little bit. We partner with folks like Pascal to make it available for folks who maybe want to come in and be able to get in at a lower minimum. But for us, we have a higher threshold because we only have a limited number of spots that we can bring in. We have over 3,300 investors today. So in the lending fund itself, we probably have about 1,500 investors. So again, that minimum is important to us in terms of, bringing in more dollars for every single investor. But again, we do have partnerships like with Pascal and others that you can get in at lower minimums. Now, with Pascal, it's nice because it's a fund to fund. He can get you in at 50,000. We don't have partnerships with other folks that can get you in that low. So like White Coat Investor, Physician on Fire, Freedom Founders, their minimum is 100 at least for them.
Great. Thanks.
You're welcome.
All right, Mark. Thank you, Brad.
Sure.
Oh, perfect.
There we go. Cool. You have the floor.
So thank you very much. That was very informative. I'm mainly multifamily and mobile home park investor, both actively and as a limited partner. So this space is new to me. So you mentioned the loan tape. I was hoping you could maybe dive into that in a little bit more detail and the types of information that you can glean from looking at the loan tape.
Yeah, certainly. So again, the loan tape will give you every property that we own or that we lend against in the fund. It'll give you the the loan amount, any kind of reserves we have on the loan. It'll give you the LTV, the LTC, the maturity date. It'll give you the term of the loan, the interest rate. So all the information you would want to look at from an investor standpoint.
Do you, Richard, do you want to keep that under wraps for this call since it'll be online, or are you comfortable with me showing what that loan tape looks like? I have one here.
Yeah, if you have it, absolutely. No, you're welcome to. And again, Pascal will tell you, we're very transparent. So if you're interested in seeing all this information, we can give you access to our investor portal. The investor portal will have all of our performance, historical performance. It'll have all of our performance reports. It'll have all of the financial statements, audits. So you'll just have access to everything, all of the historical performance reports and everything.
Okay, so it's essentially a line listing of each loan rather than just an aggregated view.
That's exactly right. You get every individual loan.
Okay.
Yep.
So they're just like
when the loan
MBSs
started,
and things like that.
Go ahead.
like mortgage-backed securities, and so this is the same thing as that type of loan too. Okay,
That's exactly right. Just that for a property level,
all right.
give you all
Okay.
the information on the loan itself. Yeah.
Fantastic. Thank you.
You're welcome.
And second question, if I could ask one more.
Yeah.
Could you explain the dividend reinvestment program? That's really unique. And
Yeah, sure. So the DRIP program is great because it gives you the opportunity to reinvest your earnings to compound. So it just means you're not taking your distributions. So for instance, I invest through my IRA. And again, we do take qualified money in our funds. So that's another opportunity and another way to invest. But because of the fact that it's in my IRA, I'm not taking any distributions. Any earnings just comes in and just goes right back in to grow the balance. So you're earning interest on interest. The compounding effect is amazing. To give you an example, in our housing fund, for folks that have been using the DRIP program, the dividend reinvestment program, if they started with us when the fund started, that was 2020, through the end of last year, they nearly doubled their money through the dividend reinvestment program. It's returned about 19.5% return since inception. So it's done really well.
That's actually the perspective I was looking at it for as well, because I use self-directed IRA qualified retirement funds to do it into multifamily, but they use debt finance, so you end up with UDFI, and so it's better to have a dividend 1099 rather than
That's exactly right.
taxes. So
Yep.
Awesome. That was another question. So thank you for that.
My pleasure.
No others for me. So thank you.
Cool.
All right.
Thank you, Christopher. Mark, kind of last chance to either type in your question or okay, there we go.
So I'm going to try this. Can you hear me?
There we go.
Yeah, you're good.
Fantastic. All right. For some reason, I could only use it by pressing the space bar when I want to talk. So I appreciate seeing the monthly returns. And what I'd be interested in is seeing an income statement that would start with the gross revenues. If let's say I invested $100,000 through Pascal's SPV here, or fund here, on January 1st of 2023. And then each month, what would be the gross revenues minus the DLP carry, the expenses, Pascal's carry, et cetera. It's all valuable. I'm not begrudging anyone any of that, of course, but just would want to understand if it's 10.39% that month, is that the net to me? Is that the gross above? I just want to understand what the net is from all that.
Every return that we show you is net to you. So that's, again, that's the only way to show it. Now, we do provide an income statement. We do provide a balance sheet. So you could see all the top line revenue, all the expenses. We keep it very clean. Yeah, great. So Pascal's showing it here. So you can see no junk fees, right? We have our promote, we have the accounting and bank charges, and that's it, right? Like it's a very, very clean, you don't have a lot of other load or other crap. Excuse my French. I mean, it's just, we keep it very simple. And that way you can follow this, and we make this available every month. You get your balance sheet, your income statement, you get a loan tape, you get the the fund report. So you just get a ton of information, and we're very transparent.
Yep. And then here's the balance sheet as well that comes out. This is all part of the monthly report that comes out that you get at being part of the fund. Kind of that similar loan breakdown that Richard showed, the returns by month and annualized, what happened that month, then the balance sheet, and then the income statement. Does that answer your question, Mark? Anything else you'd like to ask?
It's fantastic. That's very helpful. I think the follow-on question would be the other three funds. It would be interesting to see a similar kind of income statement, knowing that at least two of the funds have also the appreciation possibility, but more variability. I don't know if that's something that is accessible, but that's something I'd be interested in seeing.
Yep. So again, as we give you access to the investor portal information, all the historical returns, the historical tapes, the historical financial statements, the audits, everything's available. And Pascal and I were actually just talking. I mean, we'll probably do a series of these, go into deeper dives, not just in the lending fund, but into the other funds as well, so that we can dig in. So for instance, our housing fund is a very tax efficient fund. So we pass through depreciation to investors. And since the inception, we've created enough depreciation to offset all of the income. So we've actually generated small losses every year. So you have passive losses, which you can use against your other passive losses, passive income, right? So it gives you a really nice way to be tax efficient. We do 1031 exchanges within the fund, so it defers all the capital gain to exit. So just super tax efficient. So great way to grow your money, especially if you're doing the dividend reinvestment program, right? I mean, not bad if you can get a pre-tax 19.5% return. It's done since inception. But then if you take that after tax with the tax efficiency, I mean, it's pretty deep. It's pretty neat fun.
Great. Thank you, guys.
You're very welcome.
Yeah. All right. Any other questions? I didn't see any other hands raised. I'm going to just give it maybe some 10, 15 seconds here. Richard, do you have any closing remarks or anything else you'd like to add just based on the questions asked before we hop off?
Yeah, no, just I want to thank you again for having me on. Again, let everybody know if they need access, they can work with you to help get access to the investor portal. We'll make it available to everyone. If you have questions, you can reach out to me or any one of our colleagues here at DLP. And then again, we'd love to see you at one of our upcoming dinners or events, or more importantly, and really to get a good sense, we usually get anywhere between 300 to 500 folks who come to our annual events, the next one in June. Love to see you there in person, bring your families, have a great time. And, again, I wish everybody happy holidays and a Merry Christmas. And again, appreciate you. Thank you, Pascal.
Awesome. Thank you for joining us, Richard. And thank you everyone for attending. We'll see you guys at the next webinar.